So good afternoon and welcome everyone to another Sage Investor webinar. My name is Jen and I am a co-founder of the Sage Investing Group along with Maggie and Lana. So during the course of our webinar, if you guys have any questions that pop up in your head, feel free to just type them into the chat box. Or if you rather prefer, you can hold on to these questions and unmute yourself at the end and ask them then as well. So today's webinar, we are going to focus on helping you become a more confident multifamily syndicator by teaching you guys how to vet the operators and the markets before investing in a deal. Because if you were to ask any seasoned investor, I think they will tell you that the biggest risk involved with apartment investing will be in the order of the sponsor, the market, and the deal itself. So yes, the deal itself is actually, and the projected returns are actually going to be one of your last concerns. So in our last webinar, we focused mostly on how to quickly vet a deal so that you know whether you want to spend more time on it or to move on. And so today we're going to circle back, and now we're going to focus on in more detail on the very important process for vetting the operators and the markets. And before we get started, I want to make a little introduction about us. So all of us, we all have a Big Four accounting background, which means that our background is rooted in audit and risk management. It is no wonder that we like vetting so much, right? This is our second webinar on vetting. So unfortunately, though, most people don't really like auditors because we tend to ask a lot of questions, and therefore we create more work for them. Because we don't really tend to believe anything anyone says unless we see evidence. And of course, it takes time to produce those evidence. So although not very popular, we do see a lot of value in what we do. And we know that it can help other investors in this multifamily space. So now with our combined 35 years of professional experience in audit, accounting, finance, plus our real estate investing experience and thousands of hours underwriting multifamily deals, we do what we do now in multifamily syndications today, which is we bring vetted deals to busy professionals like you guys so that you guys can invest with greater confidence in these syndications. So today we have over 180 members in our community now and over 450 Facebook followers. And collectively, we have participated in 14 deals, which is totaling over 3,000 units and with a portfolio value of $350 million. So evidently, we believe in multifamily investing and that we think this is the best asset class for us to invest in. We've created these webinar series to essentially provide you with some educational content so you guys can decide for yourself if this is also the right investment strategy for you. The webinar is really great for anyone who has ever tried to invest in syndications before, but ended up backing out because maybe you don't feel like you know enough about these syndications, whether it's about the operators, the market, or the deal. And you maybe felt overwhelmed by all the information that is out there. So you're in the right place if you felt any of that. And so a little disclaimer, I guess, before we get started is that we want to say this webinar is really for your education. So although we all have a CPA background, Sage is not a legal, a financial, or a tax advisory firm. So please consult with those respective professionals for any legal, financial, or tax-related questions. And lastly, please know that we cannot guarantee any returns on the investments. Obviously, you know that there are always risks involved in anything that you invest in. So with that said, we hope that after today's webinar, you guys will walk away knowing what you should consider when evaluating syndication operators and what you should consider when evaluating markets to invest in. Now, with that said, let's get started with the operators. I will talk on the operators and then Maggie and Lana will talk more on the markets later. So as you guys know, commercial real estate investing is very much a relationship business at the end of the day. The investor is really investing in the operator above all else, because as a limited partner, you wouldn't really have any day-to-day responsibility, right, in these investments. So you're really entrusting a lot to the operators. You want to make sure that you're investing with a capable and experienced team that you like and trust. So one way to think of it is, let's say that you are, trying to hire a financial advisor to manage your money. What would you want to know about this person and his or her team? For us, once we have established that, we like the team and that they share similar values as us and that they are capable and trustworthy, then we want to dig a bit deeper and before solidifying that relationship and partnering with them. So we've narrowed down the myriad of criteria that we typically check the operators against. And we've narrowed it down to 3 key ones that we feel like are probably the most important for investors to consider if you have limited time. So these things are such as the track record, the operator's track record and their team, their communication philosophy, and number 3, their references. Let's go ahead and take a closer look at each one. So when it comes to the track record and the team, it encompasses quite a lot on this particular topic. This is probably the one category that I would spend the most time getting comfort over. Because when we say track record, for example, it covers a lot about who and what this operator is all about. What kind of record do they have? What kind of achievements have they had in the multifamily syndication space? And how did they get to where they are today? What experience, what expertise, resources do they have to help them get here, right? And so, by the way, when we say all this, we don't really expect the operator to really have a squeaky clean record or anything like that. We want to make sure that, we don't want them to have never have encountered any challenges in this space, because we feel like if they haven't encountered any challenges, they probably haven't been in the industry really long enough. So what we're looking for is really somebody who is capable of speaking openly about their experience, their challenges that they've encountered, and how they handle these challenges. So some questions that you might want to consider other than the challenges is what is your asset type in your asset class experience? For example, if you're investing in like a C-class multifamily property, you'll want to know that the team has the experience with these asset classes and that they have carried out the business strategy before for this type of business, for this type of type. So in regards to their submarket experience, you want to ask them, have you invested in this submarket before? Or is this a new territory for you? If it's not new, you would want to ask, well, how are your other properties performing in this submarket? And if it is new, you want to understand how they plan on mitigating the risks involved with being a new player in a new market. And even still, it would be important for you to ask about how the other properties are performing elsewhere in other submarkets. And just as a side note, what we've noticed is that in today's very competitive environment, the operators are having to look more in secondary and tertiary markets now in order to find deals that are cash flowing and deals that are generating returns that make sense to the investors. So the concept of working in new submarkets may become more common than ever before. So just don't be deterred by it. Just make sure you do your due diligence and get comfortable with that market. So moving along, you want to ask about their team. As an operator, it is critical that this person is able to gather a strong team to oversee the business plan, right? You want the critical team members, you want to know who the other critical team members are other than the core sponsorship team. And these are people such as the property management team, the asset management team. You want to know who the contractors are, who's the lender, and maybe any other advisors that are involved. We want to know that this operator has pulled together an all-star team with motivation to make sure that the project is successful. So for example, I guess on the property management end of it, is that the property management is very crucial to the team, right? They are the boots on the ground. So you want to get comfort over the property manager's track record, such as their history in the submarket, the property classes that they have managed, and how many units do they have under their management. But do keep in mind that, just because they have thousands, the bigger the number doesn't necessarily mean better. You just want to gauge their experience overall and their knowledge of that market. And other questions that you may want to ask the operators are such as, have you ever taken a deal from start to finish? And have you ever refinanced and returned capital to your investors? Just to get a feel of, the extent of their experience. So keep in mind that sometimes operators may not have a really long track record when it comes to syndication, right? But maybe they have been successful in another business, or they might have had or they might have worked in a related field with transferable skills. So don't discount that, and just make sure that, these operators are partnering with somebody who has a very strong track record in the asset class that you're investing in. So in summary, for this part of the operator vetting, just know that, it's hard to really measure, I guess, everyone against the same yardstick. But this is a part that really requires a lot of judgment call, whether or not, you think their track record is good enough, whether or not you feel comfortable with their experience in their team. So the next part is the communication philosophy. Having the audit background, we believe in transparency heavily. So we believe that open, consistent, accurate, and professional communication is pretty critical between the operators and the investors. After all, we're all partners on the deal. However, we know that the investors are investing passively for a reason. So we know that we don't want to over communicate and tell the investor about every work order that's been submitted at the property. But you do want to know that, how the property ultimately is performing, and if anything has occurred that could potentially impact the business plan and the operations. So some questions that you may want to ask the operator to kind of get a gauge on, the communication style and philosophy is, how frequently will they communicate with you once you invest in their deals? Typically, they should communicate at least once a month on updating you on the property operations and performance. And what types of reports will they be sharing with the investors? So they should be open to sharing rent rolls with you, the financials, balance sheet, income statement, the balance sheet on the property. And you may also want to ask them to see examples of communications that they have sent to past investors, just to kind of see the level of detail that they put in their communication to their investors, right? And to see if that's, comforting for you and if that's sufficient information for you. I think everybody has a different level of detail that they want to see. And so this is probably a good way for you to judge the level of transparency and detail by seeing their past communications. And then lastly, you want to know, how do they approach sharing big news with investors? Because, these investments are long-term, 5 to 7 years old. There will be good things and there will be bad things that will happen during the course of this partnership. And you want to know how will they go about, how quickly and how quickly and the method that they will approach telling the investors, bearing whether it's really good news or whether it's bad news. So I guess, in speaking to the operator, you want to get a feel essentially for whether that operator is likable, whether they're approachable, and whether they're going to take that time to answer any questions and concerns that you may have during the life of the investment. So lastly, we think it's really important to get references and to ask others about their experience with that operator. These days, everybody is reading reviews before buying products and services. So why not apply that to vetting your operators? One thing we recommend is maybe not to ask the operator directly for references, because obviously they're going to give you good ones. Nobody's going to give them somebody who doesn't like them. So, this may pose as a challenge, I think, to some investors who may be new to this and really don't have a lot of connections yet. So just do your best and, maybe try to go on social media and follow that operator for a bit. See, maybe try to talk to some of their followers because, chances are that their followers may be investors of theirs as well, or maybe they know them, ask them like, how they know this operator. So try your best there. And also, of course, Sage is also a good resource if you guys need help with that. We know quite a few people. So some questions to ask the references, some questions that you want to ask the reference once you get them are like, have you had a good experience working with the operator? Have the investments performed against the projections? What has the sponsor promised promised to the investors but have not delivered? What has the investor promised and deliver? And then how does the sponsor handle unforeseen issues? So other things that you may want to consider, which aren't super critical, but just keep these in mind when you are vetting the operator, is, you want to know right off the, you really do want to know, I guess, sooner rather than later, if they work with both sophisticated and accredited investors, or if their opportunities are only open to accredited investors. Because, if you are sophisticated, then there's no point in vetting somebody who isn't opening their deals up to sophisticated investors, right? And if anyone has any questions about, the difference between sophisticated and accredited, we can answer that at the end. And then you also want to know what the sponsor's fees and fee structures are like, just to get a feel for, making sure that they're not overcharging you as an investor for these services. Commonly, the services and fees that we see in the deals are acquisition fee and the asset management fee. And these range from usually 1.5% to 2%. And then there are a few other fees, construction, disposition, and refinance fees that are optional. They're not always included in every deal. So anyways, just check those fees and just make sure that they're reasonable. And if they're not, talk to the operator and ask them why they're charging more fees. And typically you want to know what the investor and sponsor split is as well on the distribution. What we typically work with is a 70-30 split between investors and the investors. And the sponsors for the profits. And then you want to ask them how frequently they visit the properties, obviously, because especially during the transition period, it is pretty critical for them to be on site to make sure that the project is starting off on the right foot and that they're setting the tone for the new management team. And then you want to know, is the operator investing in their own deal? How much fund are they investing in their own deal? Having the operator invest money obviously shows more alignment of interest. But let me just tell you that from an insider's perspective, we know that there's a lot of sweat equity that goes into any deal. As it takes maybe 50 to 150 deals of underwriting deals these days to just land one. So that's a lot of time, and effort on the operator's part just to bring that deal to the table. And just also know that the operators will generally have, fronted at-risk money. So that means that these are money that they could lose if somehow the deal falls through. So they are putting a lot of, their own funds, their own time and energy into these deals. But, lenders typically will require the operators to invest at least 10% of the 10% of the deal into it, because as a lender, they are the biggest investor in this deal, right? So they want to make sure that the investors also, or the operators also have skin in the game. So let's see. So lastly, I just want to let you guys know, during the Sage vetting process, we all, not only do we take the time to ask all those questions and, do all these researching online to vet the operator, but for good measure, we also hire a third-party vendor to conduct background checks on the core sponsorship teams. So these are anyone who makes any asset management decisions and who have access to the entity's bank account. We want to make sure they're working with good, ethical people. And so these background checks, we make sure that there are no unfavorable unfavorably resolved lawsuits involving allegations of fraud or other similar misconduct. We make sure that there's no regulatory sanctions on these individuals for at least 7 years. And we want to make sure that there's no felony or criminal convictions on these individuals for the last 7 years as well. And for the deals that obtain financing, which most of our deals do, the lenders will also conduct their own due diligence on the operators, and they will, in their search, will include a credit check as well. So it's pretty comprehensive. So now I'm going to pass it off to Maggie, who's going to talk more about vetting the market.
Thanks, Jen. I just wanted to be cautious of time. We're running a little bit behind, but so if you guys have to drop off, feel free to do that. We will be going. It is a little heavier topic today, so we do understand if you have to leave, drop off. We will have a Sunday replay out. So without further ado, we do want to talk about the market. It is a critical importance when determining whether to make an investment. Real estate agents often say that the only thing that matters is location, 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 and it's not without a good reason, right? And the two main things we like to take into consideration is market fundamentals and economic trends. And for market fundamental, you're really looking to see if the market has a good environment or climate that's prime for real estate investing. And for market trends, you want to see some indication in the data that evidence that there's growth in the market and it's heading towards a good direction. And there is a lot of data information we dig through. And for the purpose of this webinar, we just want to highlight some key areas that you might want to consider for market fundamentals and economic trends. So for market fundamentals, some of the things that you want to look for that will shed some light whether a market is prime for real estate investing is one is the market landlord friendly, and there's two sub points to consider. So A, you want to understand how complicated the eviction process is, and is it a quick process and a slow process? For example, in Virginia, we learned that the eviction process is generally 6 weeks versus Des Moines, Iowa. It only takes 2 to 3 weeks to process a eviction, and the eviction process doesn't just vary at the state level, it also varies at the county level. Doesn't mean that you shouldn't invest one over the other. It's just that you should take into account and understand how to factor that into your projection. B, is there rent control? Ideally, you want to buy a rental property in a market that doesn't limit rent rates or has a more lenient regulation on rent increases. And that wraps up the bullet points in regards to investing in landlord-friendly market. Second part on market fundamental is you want to know if people are moving into that area, especially in post-pandemic times when people have a bit more freedom where they choose to live, thanks to virtual communication, regardless of where their employers are based. So you want to check where people are moving to. U-Haul actually has a great article covering what are top cities that people are moving into post-pandemic in the US. Number three, we want to ask if there's a diverse job market in a particular market. You don't want to see an industry or a sector that's greater than 25%, or you don't want to see one employer that's employing half the town, which can pose a concentration risk. And Lana will go into a little bit more in details later. Number four, you want to know how crime rate is trending. Lower crime rate correlates with a more positive experience amongst tenants, which means more reliable rental income. And we can cover some more some sites that you may want to check out later. Okay, economic trends. You want to see some indicators in the market that shows growth in the market and it's heading a good direction of some things. And something you want to consider is the population growing? Is there income growth? Is there median home value growth? Is unemployment going down? Is vacancy rate going down? And is rent growth going up? What you want to see here is to gauge where is the market heading, and just a general guideline or benchmark for a market that has above 500,000 in population. We generally like to see over the past 20 years that has grown 20% in population, 30% in median income growth and 40% in home value. And there's no real science about that number. It's just something we like to see. We also compare these percentages across other markets and overall on the US national level, just to get a good perspective on how that market is trending. Okay. We share a few things to look for when betting a market. You can easily Google some of these points, but for added references, we jotted down a few sites that we regularly uses to assess a market. We do have access to a paid subscription database like CoStar that provide a more robust market coverage and in-depth reports. But we still frequently look at these sites to do a quick check or just to get a lay of the land. Just want to mention a few things to keep in mind. The market data that I share with you in an investor deck may not always tie to what you find in the Google search, Google research, because different points and time and when you pull and refer to data and how the data is aggregated may vary. And that's okay, because essentially you're just looking to see if the market indicates a positive trend consistent with what the deal sponsor may be telling you. And for crime, just to highlight, we do look at crime rates on citydata.com to see if it's trending down over the years. We also like to do spotcrime.com search, which tells you the crimes that are committed in a particular submarket. So you can assess how frequently the crimes are committed and how serious the offense are in a particular address or location. Also, I want to caveat that when you Google search, you might come across something that seems alarming. But as you may know, a news coverage of a particular point may sound far worse than it is. Like if I do a crime search around where Lana lives and in the Bronx, we might be concerned for her safety. And as Sage, as a company, we should probably put some life insurance policy on Lana to mitigate that business risk. But in all seriousness, crime is relative, and it is everywhere, especially where there is a large population. But we know that it isn't as frequent as we hear about it. If you do find something that concerns you, just bring it up to the sponsor and see what their response is, and you can determine how you feel about it. Also, know that the lenders are also doing their market due diligence and reviewing crime on properties. And if necessary, they will require the sponsor to implement risk mitigation measures. Now that we covered that factors to look for in the market, Lana is actually going to take you through a few examples how you can look for some of these factors. Lana?
Yeah, thanks, Maggie. Okay, so for the purpose of example, I just wanted to share a market that we've been looking at, and I thought I can share some of the things that we've been doing to vet this particular market. And in this case, it was Des Moines, Iowa. So Maggie talked earlier about how population is one of the economic trends of the market that you want to look at. In our search of Des Moines, we were seeing a 22% growth over the last 10 years. It helps put this into perspective. So we took at a few other markets, and on a relative basis, what we were seeing is that Des Moines is outpacing its peers in the Midwest, including Chicago, St. Louis, Kansas City, and Minneapolis. And it trails just behind Dallas, which we all know is a well-known growing market. Now, this is just the results of my search. I'm going to quickly show you how I did my research. And in this case, I just did a simple Google search for population growth in Des Moines, and I got this macrotrends.net website as one of my options. So when I come here, I'm just let it open up a minute, load up. It gives me just kind of a quick snapshot of what the increase has been. But the thing that I look for, just as a quick summary, is here's that population growth. And you see over the blue line, it's trending up. So that's a pretty good sign. And then down below, sorry, things are still loading up here. Here's where I was able to calculate that 22% growth. I just kind of saw, okay, population was 552,000 as of, I guess, as of 2021. And back in 2010, it was 452. So that's 100,000 population growth. But really, instead of doing the math, you can just quickly scan and see, okay, over the last 20 plus years, you're seeing a positive trend year over year of at least 2%, 1 to 2%, which is a good thing. And how I did this as a comparison point is I just looked a few other markets in other cities in the US to do the same exercise and see, okay, I'm seeing this growth rate. How does that compare to Chicago? How does that compare to Dallas, et cetera, to pull that chart together that we saw earlier. Okay. So unemployment rate, that was another economic trend that Maggie had mentioned that we would look at. And in the Des Moines market, what we saw was that in the close of the 2020 year, the unemployment rate was at 3.4%. Now, this sounds incredibly low, but similar to the population, it's much more meaningful when you look at it on a relative basis. So we looked at how does it compare to the US national average, and then also on a historical basis. Now, we know 2020 was a crazy year, and it's no secret that it was a challenging year for employment to many. Kind of pulling up information that I got from the Department of Numbers, which was sourcing its data from the US Bureau of Labor Statistics. Okay. I was able to see that not only did Des Moines maintain unemployment levels just under the US national average, but on a historical trend, it was showing recovery just after the peak in April. And now it's close to levels close to pre-pandemic levels. And so just to kind of show you what the website looked like that I pulled this chart together from was this. You can see Des Moines is showing at 3.4%, nationally it's 6.7%. And this is just the monthly snap, but you can see year over year with peaks in the 2009 recession and again, the 2020 pandemic. So other than economic trends, Maggie also talked about market fundamentals, one of which being, is there enough diversity of industry or sectors and also employer so that we don't have any concentration risk? Think of this akin to, that sage advice that we've all heard of before. Don't put all your eggs in one basket. So a rule of thumb that we like to use is a 24% rule, which just means that we don't want to see a concentration of any one sector of more than 25%. And in the case of Des Moines, we're seeing a sufficiently diversity across the sectors. We see trade and transport, finance, health, and manufacturing, to name a few. And this is good because you want to see that they're able to weather out any downturn of any one particular sector should it ever occur. I happened to search for industries in the Des Moines market and came across this data DSM, which just means Des Moines, USA.com, where I sourced the above this information. To determine that no one sector dominates the industry or this market, I should say. And I'll just pull it up really quick so you can see what I looked at. And this is where I pulled this information, and I just pulled it to run the percentage calc myself. So here you can see what is the employment growth percentage. You could also see what new jobs have been added from the last 10 years. So there's a lot of wealth of information out there. Just quick. And then similar to the exercise that we just did on the sector industry, we're going to want to do the same for the employer, right? Just want to make sure that no one employer dominates the market for the same reason. We can apply that 25% rule that I mentioned, but in this case, all I simply did was I looked up in Des Moines' own website, municipal website, and they listed out who the top 5 to 10 employers are in this market. And what I saw was that the top employers in this market weren't also the only employers for their sector. For example, Wells Fargo is So for example, Wells Fargo is a finance company and a leading employer in this market. So I just wanted to make sure that they aren't also the only finance company in this market, which we saw that wasn't the case in Des Moines. We saw Principal and Nationwide. And we also saw that it wasn't only concentrated in finance. Some of the other leading employers in there covered the health and manufacturing industries. So good diversity. Oops. Okay. So with that said, we've now concluded close to the end of this webinar. I just want to quickly recap the importance of what the session was to cover. It's really about vetting the operator in the market, And then the operator, we want to make sure what's their track record, what kind of experience they have, and what's their communication philosophy, right? Because you want to make sure that we're providing our investors with the right level of information and references that to the extent that is possible, that you can utilize to get a little bit more familiarity with the operator. And then as Maggie mentioned or covered, you want to look at the market. And there's two buckets that you can really kind of consider. There's the market fundamentals, which is, are we investing in a landlord-friendly state? Is there enough job diversity in that market? And then for economic trends, are we seeing good positive population growth? Are we seeing good unemployment rates coming down? So these are just kind of some of the things that we would look for. With that said, I'm going to hand the mic over to Jen to close us out for this webinar.
Thank you, Maggie and Lana, for that great market overview and vetting process. So now we are open to answer any questions that you guys may have for us. Like I said, you can enter them in the chat box, or you can just unmute yourself and ask these questions. And then just before, I let you guys start talking, just wanted to say that, if you guys found this webinar to be helpful, and if you know of somebody like a friend or family who may be interested in learning more about investing in these multifamily syndications as well, please feel free to refer them. You might even want to invite them to one of these webinars, right? The more the merrier. And so if you or anyone else who is listening on this webinar are not, in this, not in our investor circle yet, or maybe you know a friend who might want to join, you can refer them to our website at www.sageinvestinggroup.com/join now. And you or your friend will simply need to fill out the questionnaire, and most importantly, set up a call with us, because we want to get to know you. We want to see if what we have to offer is a good fit for you and your investing strategy. So thank you so much, guys. And we're open to any questions that you guys may have for us. I'll give you guys a moment if you need more time. Let me see. Let me check in the chat box. Dawn, do you have a question?
Yeah. Can you hear me okay?
Yes.
That was a great overview. I really appreciate it, because it's been a while since I've been kind of circled back around on some of these key points. My question is super basic. Can a passive investor, can you give me like an example of how a passive investor can actually kind of become, a substantial wealth accumulator as a passive investor versus, should I be setting my sights more on the GP and the in that way? I mean, it's kind of a general question, but if you could address it, that'd be great.
That's a great question. So, Malan, do you want to answer?
Yeah, I think the main question there, it's probably a more personal question, is how much time do you have readily to commit, right? Because you say you have the capital and you want to put it to invest it somewhere. You can do that as an active or a passive investor. The main difference is, as an active, you truly are that. You're active. This becomes a full-time job. Vetting the market, vetting the operator, vetting the deal, it takes some time. Meeting with the property managers, meeting with the construction managers if you're doing a big value add or rehab project. It certainly takes a lot of time. So I think it really is a question for how involved you want to be. And if you like being hands-on and you like being involved, you may want to think about, okay, maybe it's time to take a more active role and become an active GP, and then figure out how to build the right team, or get, be asked to join a team that maybe sort of is established. I don't know if that helps answer your question. Yeah.
Well, Jen, what I've done, just that one deal on Magnolia Terrace. And it's been awesome, just really awesome for tax write-off. Write-offs, right. It's been fantastic that way, absolutely fantastic. And so it does fit the going forward for sure. So when, you know, that rolls over and that's paid out, not the monthly, but an actual, you know, they sell the property, then you can upscale with the new amount into another deal. You know, I kind of get that leapfrogging kind of thing. So maybe this is a deeper question for another time, but so there is that potential for kind of gaining, based on your time frame, gaining more and more equity portions in each deal. Does that sound right?
Yeah, no, that sounds really good. That sounds right. And then I want to add on to what Lana said too. You know, if a passive investor want to take more of a substantive, you know, portion of the equity, and if they maybe have maybe single family investments or, you know, portfolio of single family investments that they want to sell, you know, there are also opportunities for the passive investor to do a 1031 exchange into syndications, right? And then you become a partner, a tenant in common with the syndicator, and then that allows you to take a much bigger role as well. And then, you know, another way I'm thinking of is, you know, a lot of investors, they can also, you know, they have obviously, it's more challenging, I think, to obviously have a big pot of money saved up to invest in, you know, multiple deals, right? We all have so much limited resources, right? But, you know, a lot of investors, they can also, you know, tap into their retirement fund. You can create a self-directed retirement fund because we've all been working for like decades now, and we've accumulated our retirements at this point. And so a lot of people, they will, you know, create a self-directed retirement fund, and they can direct that money, which probably is in larger amounts, to these syndications as well, and help grow, you know, the wealth and build a bigger nest for their retirement.
Just something to caveat, because I think your main question here is how do you keep, you know, basically you accelerate your wealth growth. It sounds like that maybe is your question. Okay. You know, something to keep in mind, like there isn't any real differentiator between accelerating your growth. It depends on how you invest in it, how much you can invest. So if you're passive or active, it's generally the same. On the point that Jen mentioned, if you're using, you know, you can source your capital from your retirement funds. The one caveat is if you're an active investor or a GP, you typically can't utilize your, you know, retirement fund to invest in your own deal, because then it's, you know, almost like a conflict of interest, right? So just to keep that in mind, that you may be only limited to utilize those funds purely as a passive investor.
Thank you.
Yeah.
Yeah, thank you, Dawn, for such great questions. We appreciate it. All right. Anyone else have any questions? If not, you know, you guys are welcome to email us if you guys have many afterthoughts, and, you know, email us anytime with any questions that you guys have. But yeah, I think we're good.
I have a bunch more questions, but I'll just send those to you, Jen, and you guys can discuss it, and, you know, surrounding the passive piece. So
yeah, definitely. We'd be happy to jump on a call with you, Dawn, anytime.
Okay.
So yeah, thank you so much, everyone. And we'll go ahead and send a copy of this recording out to you all after this afternoon. So thank you, and take care.
Thank you
For attending. Bye.
Thank you.
Thank you.